Hello, everyone. Welcome to the investor panel discussion at IOSG Old Friends Reunion DeFi Summit. My name is Xing Shu. I'm a partner at IOSG Ventures. A little bit of background of IOSG Ventures. We are a venture fund focusing on investment in the blockchain and digital asset space. Founded back in 2017, we've so far invested in more than 60 projects. In terms of our DeFi investment, in 2017, we invested into MakerDAO and DDEX. And our more recent DeFi portfolio projects include 1inch, UMA, Synthetics, Gelato, Dodo, and the like. Today is my great pleasure to have leading investors in the space with me, and we're going to have a very fun conversation talking about the new excitement, new challenges, and new investment theses in the space. So I think we can kickstart by around a quick introduction of our panelists. So maybe we can start from Ben from Polychain Capital.
Hi, everyone. My name is Ben. I am at Polychain. I've been there for just over 2.5 years now. Polychain obviously has been very prominently involved in the space. We invest at pretty much every layer of the Web3 tech stack, from layer ones up to sort of like user-facing applications, and then also in like market infrastructure type businesses like exchanges and whatnot. We were some of the very first investors in the DeFi space, the first investors in MakerDAO, for example, and some of the first and largest investors in Compound. We've obviously followed the space very closely and made subsequent investments, since those very early ones. This year has been obviously very interesting for us, and we have been, following the developments very closely, and look forward to, continuing to be involved and continuing to make deployments into interesting projects and capable founding teams.
Thank you, Ben. I think we share much of the same focus in DeFi investment. I think it's really exciting space to see we have made good progress in terms of understanding the space, in terms of leading the space for the development in the next stages. I think maybe next we can hear a little more from Michael from Framework Ventures.
Sure. Hey, this is Michael Anderson, co-founder of Framework Ventures. We started about 1 year and 3 months ago. We specialize primarily in DeFi. We're a bit of a different firm in that we have a venture thesis fund, as well as a technology development company called Framework Labs. We employ a team of engineers, technologists, developers, program managers, who participate in most of the applications within the DeFi space, even sometimes before we make so most of the time we're large users of the DeFi protocols, as well as investors in them. Some of our biggest wins thus far, Chainlink, Synthetics, Aave, Wi-Fi. We're really excited about what this next year could bring and all the attention that DeFi has had over 2020.
Yeah, that's really exciting. Remember, we spoke, I think some weeks ago, Michael. I think it's really interesting to learn how you guys really get very hands-on with your lab setting and can do very specific things to grow together with the project. Thank you for being here. Santiago, I think we all know what Parafy roughly invests, but I think maybe we can talk a little bit, especially about what are you excited the most in your recent investment?
Yeah, definitely. Parafy, like Framework, is solely focused on DeFi, and really where we take a unique approach is being active users of these networks. That really informs our thesis in the space, how it's evolving. Liquidity is the lifeblood of these networks, and so by being active users, we consider ourselves users first, investors second. I think I'm sure we'll touch on this, but a lot of this year has been, to Ben's point, kind of a renaissance in DeFi. But there's been 2 years of active development, and so that's something that I think a lot of people don't really appreciate. There have been protocols like Synthetics and Aave that have been Maker and Compound that have been building for the last 2 years in earnest. And so really what we're seeing now is the next iteration of that progress. And so, I think we're still very early. A lot of these are still experiments, but I think we're entering a second phase in DeFi.
Yeah. Thank you, Santiago. I think you just brought up a very important point because many people probably see more of the fruits we are seeing this year in the DeFi space, but actually there has been a lot of hard work, years of hard work putting into that. And before this year, people probably were having a lot of even challenges in convincing the community that this is the thing. So we really should congratulate all these teams that has spent years in building the cool stuff so that we can see the proliferation of DeFi this year. I think maybe just to answer one question that our audience will be very curious about, from early on of our discussion. What do you see will be the new type of DeFi applications that are going to emerge in the near term, let's say in the next 6 to 12 months? Maybe this time again, we can start with Santiago. Why don't you share your thoughts first, if you don't mind?
Sure. I would have rather been last on this one, but I guess, I think, we're starting to see you have protocols that are built core infrastructure, like core money or verbs in finance, like lending, borrowing, insurance, derivatives. And so I think like that was the first instantiation of DeFi, and really a lot of what we've seen is copying traditional models in finance into this sort of highly integrated and composable ecosystem. And then the idea is, okay, what do we do with that, right? Because I think like there are a whole host of applications that can be applied in this. What I think of DeFi broadly speaking is transfer of value with digital scarcity, with programmed incentives, and so that really in global pools of liquidity. And so I think a project like Barnbridge is perhaps a good example of that leverages a lot of infrastructure that has been built historically to create tokenized risk and tranching and creating effectively structured products 2.0. And so it's, I think I'll sort of pause there because I'm sure Ben and Michael have a lot of things to say on this point, and then maybe we can come back around. But yeah, I think, excited about the projects that are now building on top of synthetics, on top of Aave, or leveraging a lot of these Legos, if you will.
That's right. And I certainly agree with you that we have already started witnessing a process where some of the products and structures in the traditional finance are now being experimented in the crypto space. So I'm very excited about all these experiments. I'm sure that not 100% of them will find their success in the crypto space because many things are different. But I feel this is a necessary process so that we can at least test all these ideas. And I'm sure some of the innovation will also come in the process of making it localized within the crypto context. Yeah, Michael, you have any thoughts to share? Anything to comment on?
Yeah, definitely agree with everything Santiago put out there. I think the way that we think about it, at least in the progression, maybe not of the investment landscape, but of DeFi in general, is that the next iteration or wave of DeFi is going to be eating centralized crypto finance. We're already starting to see this with DEX volume, Uniswap surpassing Coinbase in September.
That's right.
The next phase of that will probably be something, a flavor or two of decentralized derivatives coming online in the next 3 to 6 months. And as we look to the future, it is the bridging of CeFi and DeFi, TradeFi and DeFi, however we want to call it. That is the third iteration, after this spark that we've seen in the last 6 months, the next 6 months being DeFi eating CeFi, and then moving into traditional finance. I think that's kind of the way that we like to look at the world.
Yeah, I mean, just a follow-on question on that. In the process where DeFi is eating the pie of CeFi, do you see it as an inevitable process where some of the more centralized elements and components will have to be included into DeFi? And what would be the implications if that's the case?
Well, the eating of DeFi or DeFi into CeFi is really, the disintermediation of the centralized crypto borrow lend desk, the disintermediation of centralized spot exchange, because you now have, for the first time, you have a DeFi product which is open and transparent and fair at a product level table stakes with what you would have in a centralized exchange or a centralized borrow lend desk. And that is a competitive advantage from a product perspective because you can apply trust, cryptographically secure trust, to something that is the exact same product look and feel. And then it becomes a question to Santiago's earlier point about liquidity and availability. But as more assets flow into DeFi, that becomes less and less of a concern.
That's right. That's right. Yeah, thank you for the points. Ben, I'm sure that with the background of Polychain, you guys have been investing into DeFi from like a broader sense as part of, let's say, your thesis into Web3 or decentralized economy. What in that sense, what do you see as DeFi going forward in terms of its progression? What are the new applications we're going to see, whether it's within just the DeFi space or it's more about the interconnectivity between DeFi and some of the other applications in the blockchain space?
Yeah, I'm going to cheat a little bit and zoom out just a little bit because Michael and Santiago covered a lot of the, I think, specific products that we're likely to see.
Yes, please. We love that.
So I think you've hit on a couple of them. Interoperability, I think, will be a huge one. And, as new interoperable networks come online and become feature complete, I think, Polkadot is a great example here of one that is not even feature complete yet, but that is already starting to see the beginnings of a kind of DeFi movement taking root. And I know there's already conversations about how to get exogenous assets onto Polkadot. And I think the implications there for the broader DeFi landscape are very interesting. I also, I think that Santiago is absolutely right that as with any sort of financial or capital markets, liquidity really is king here. And so, I think one of the things that we saw this summer that, really exploded and I think took a lot of people by surprise were these novel new incentive structures built around bootstrapping new pools of liquidity. And the real interesting factor about that in my mind is that it really changed the way that a lot of people were thinking about capital structures and kind of incentive structures in the broader crypto landscape, because the capital structures in these new DeFi protocols that have, let's say, yield farming component built into them for liquidity contributors is very different from the capital structure of, say, a layer one, where it's kind of like the underlying asset is what secures the protocol, and the more distributed it is, the more value that protocol has, because the more secure it is, the larger the network, the more decentralized it is, all that. A lot of the capital structures that we started to see, with some of these DeFi protocols and yield farming was really kind of an inversion of that. It was sort of a separation of, the founding team and, decentralization, and more like, the bigger and the faster that you can get in, the more money you're going to make from yield farming. And at the same time, those protocols and their token structures can so easily be forked and tweaked and replicated and redeployed, right? And so then I think you run into a very interesting question around, like, how do you build a defensible DeFi protocol? How do you bake in an incentive structure that protects the protocol from these kind of vampire attacks, while at the same time preserving some kind of capital structure and incentivizing liquidity over the long term? So I think we're going to continue to see iterations on that. I mean, I think that the design space here is still very, very new, and I think that we're going to continue to see interesting ways for people to try to incentivize this new liquidity, try to aggregate pools of liquidity, new ways to govern and deploy pools of capital in truly decentralized and anonymous or pseudonymous ways. That, again, I'm kind of cheating here because this is a little general, and I think the timeline probably is going to be a little bit longer than 6 months, but who knows? I mean, the space is iterating really quickly, and I think these are some of the clear trends for me in a direction where, a lot of these questions are still unanswered.
Yeah, I think that's a good point. Yeah.
And Xingyu, I was just going to add
Sure.
2 data points, actually. One, to us, it's all DeFi investors. I think one metric that at least we follow closely is the percentage that DeFi encompasses of the entire crypto universe. And
Mm-hmm.
to me, that's really baffling in the sense that you have the most amount of innovation, the most amount of product market fit, earnings, cash flow, a number of metrics that just are, I think, leading the crypto space in general, yet DeFi encompasses less than 5% of the entire crypto market cap. And so I think for us, you know, it's important to zoom out because I think a lot of people in this correction of DeFi, to Ben's point, we saw a repricing, we like to call it, of DeFi assets, where people sort of woke up that these protocols, unlike a lot of layer ones, actually are usable and they're not in entropy state. There's a lot of activity, a lot of energy and capital moving around. But still, I think, you know, when something goes quasi-parabolic, it will cool down. Like it's fine. These are the way markets work and market cycles. But by and large, you got to zoom out and say, hey, look, we are still very early. And I think, you know, I certainly can't explain why DeFi still is less than 5% of the entire crypto market cap. Because I'll tell you one data point. When we talk a lot to TradFi, and the beauty about finance is people don't use your product for the sake of just because they are crypto anarchists or cyberpunks or what have you. People will use, in finance, the ROI is very tangible. You can save basis points by interacting with Curve or Uniswap because your capital is much more efficient using these protocols. And so I think a lot of the discussions really miss the point. People that are high frequency traders or come from traditional finance backgrounds really don't understand a concept like Uniswap, and they get lost in a couple of elements, or they get lost in, hey, DeFi really can only exist in exorbitantly high yields, which is not necessarily, I mean, sort of, if you're stuck on that, you're missing the number one point of DeFi, which is the moment you unlock friction, and finance has a ton of friction, you are going to unlock non-linear consumer behavior, non-linear movement of capital on a global scale. We haven't really scratched that surface yet.
That's right. Yeah, I think it's both worrying and at the same time exciting to see that, you know, DeFi is less than 5%, because that means there's a huge potential. You know, I guess we are seriously talking about true DeFi, not those just other projects that are trying to sneak into DeFi to take on the ride. But I think how can we talk about DeFi and the space without talking about yield farming, right? Naturally, some of our conversations have already reached a point where we need to just delve a little deeper into yield farming. I think it's a phenomenon this year with this yield farming increase. Everyone now talks about DeFi list, and with you know all these yield cooling off, as Santiago just mentioned, I think people started to rethink about it. So I think it's very natural. But what are your thoughts in terms, your overall thoughts in terms of yield farming? Do you think this is something that's just one-off? It's more like a catalyst to the bootstrapping phase of DeFi, or it's going to last with something more sustainable? Maybe we can start with Michael for this one.
So one thing that I think Ben touched on is that tokens represent a fundamentally new design space for value accrual and value capture, and a coordination mechanism that just hasn't existed in the world yet.
That's right.
Something that's digital and scarce, and that's, you know, oxymoronic before 2010. But I think that the thing that we are testing now with yield farming is different mechanisms and the most efficient ways of distribution of that incentive layer that can bootstrap, it can incentivize, it can build liquidity and users and engagement to the point where you have a fully fledged, fully functioning ecosystem that, to Santiago's point, is basis points cheaper because it has this liquidity model and because it had this incentive model. I think, you know, in the ways that many of the protocols are built, the incentive model will last for years, which means that the core teams and the protocol developers have years to figure this out. In some cases, the incentive model will last forever. But what we are now seeing is for any digital ecosystem, whether it's financial related or not, if it's a purely digital ecosystem, we now have a new business model for it, which is some incentive layer and coordination mechanism that didn't previously exist. It's only been around for the past 3 years, probably, and in earnest. And what we're now going to be testing is the different ways in which you can distribute that properly and efficiently.
Yeah, I'm to a point. I'm actually consider, I guess, an atypical yield farmer because I tend to farm on these more sustainable projects. I supply liquidity on compound even before the incentive program started. So they didn't give me retrospectively, but that's fine. And even today, I'm still mining on compound because I just feel that the model there is probably more sustainable. Yes, the risks are not the highest, but I think that makes just more sense to me. But I guess I'm like a little atypical. Most of the farmers in the space are trying to go after the highest yield. I don't know what are your thoughts on this? Do you have any advice in terms of people who are super excited about yield farming? Should they look at those more stable things that already have their token allocation for the next 3-4 years, or probably that's not the best strategy in terms of yield farming, and you have to keep looking out for new pool every other day, which is certainly tiring. What are your thoughts on this? Ben or Santiago, you have anything to share? Do you guys really mine yourselves as well?
I guess we're active farmers for sure. I mean, we again, as liquidity providers, we supply capital across DeFi. Getting tokens, to your point, is an added incentive. Now, I do appreciate a lot of people are sort of liquidity locusts, like they just sort of go from farm to farm.
That's right.
Chasing
and they can't
yield.
sleep, by the way.
Yeah, definitely. Look, I mean, the sustainability of that is questionable. I think I always go back to synthetics. In my mind, really kind of nailed. A lot of people think liquidity mining is rather new, but synthetics really kind of pioneered this model almost 2 years ago, actually. Now it was, these sort of incentive schemes also exist in traditional venture, right? You look at companies like direct to consumer, Instacart and Uber and
right.
Blue Apron and all these food delivery services. They give you money away for free, right? There'll be and really it's subsidized by VC dollars. Just great. I mean, if you're and as a consumer, it's the best kind of gilded age because you can pretty much get everything for free if you just hop around from Instacart to Shopify and all these different products, what have you. And so anytime you throw $100 bill in the street, someone's going to pick it up. Like that is clear as water. So I always think, hey, to your point around compound, would you rather have 100 avid diehard supporters that are going to feed you and become active community members and partake in that? Or would you rather have 1 million users come in for one day and then leave the next? And so it really is a matter, to Michael's point around sustainability. I think we are very much experimenting that. I think no protocol has really nailed this in the right way. But I think from first principles, the most important thing is no amount of financial engineering has ever solved for a crappy product. If you don't have a good product, you will not make up for it with yields. Compound is a fantastic product. We're investors in it. It has been building over the last 2 years. Synthetics offers a really, really differentiated experience and access to derivatives, right? And so I think at the end of the day, we probably will look back at this crazy yield farming phase, probably won't be the last, and look back and say, look, that was a good experiment to raise eyebrows from the, attract attention. But at the end of the day, I think the real builders continue to build and the good products persist and are the ones that over the long term end up really kind of striving or becoming leaders in the space.
So one thing I'll add to that, just to piggyback off of what Santiago said, just picking up on one thing, I think if we look at maybe compound versus synthetics, and they're not comparable products, but they are similar token models where they're distributing tokens to users of the protocols. What we also have with this new design space is for the first time community ownership, which is user ownership. And what you get with these tokens ostensibly is some sort of governance rights, either now or some promise of it in the future. And the analogy that Santiago has is great in that VCs are funding the marketing spend for many of these direct-to-consumer platforms. But what they're giving is dollars, effectively. And protocols are giving is governance rights plus value. Whether it's in the form of dollars, it could be translated into that at a very quick transaction. But what we've also seen with the token economic design, and this is something that I would put on to all the different protocol founders who are thinking about yield farming, is when you design your token, you have to be extremely careful about how you design the incentive model. 87% of all comp tokens that have been mined have been sold within 3 weeks. At the same time, the almost reciprocal of that with synthetics, with the unlocking in May 2020, has been sold once those incentives have been unlocked. And I think with that extra year, with that further out point of unvesting or vesting of the tokens, I think that's a novel approach. And so if you're thinking about governance, if you're thinking about incentives, really be very careful about how you design it.
That's right. Yeah, that's a good point. Ben, you have anything to add on to this?
I think they pretty well covered it. I mean, I think the reality is there will always be a long tail of projects. Now that the idea of these like liquidity mines or yield farming incentive structures exist out in the world, there will always be people trying to leverage them and capitalize on them, and there will always be users who are willing to follow those yields. I don't necessarily think that's a bad thing. I don't, I think like it's true also that there will be projects that are more sustainable and that have longer term staying power. Again, I think that like as the space continues to expand and as we start to see more complex opportunities like, lending between protocols using bridges or interoperability protocols or these various kinds of like lending and arbitrage opportunities, I think we're going to see a lot more of this. And I think I think Michael's exactly right that like this is a new design space, and the token economy has fundamentally changed the way that these protocols can attract users and bootstrap liquidity and incentivize participation and incentivize governance participation and upgrade themselves over time. So do I think yield farming is here to stay? To some extent, yeah, absolutely. I don't think it will be the thing that everyone is talking about or chasing a year from now. But I think this is another situation where the cat is out of the bag and you can't get it back in.
Right. Yeah. I like this mindset when we are looking at this. This is something very new. It's not very straightforward to go back and look in the textbook to see how we should better have done this. I think we are all exploring. I think one difference between the VC-backed model in the traditional venture space as well and what we have today in the DeFi space is that here we are not exactly bounded by your cash flow. So for example, you are not giving out people cash, right? You're giving out people tokens. You have greater flexibility here in terms of how many tokens you can give to people. But with that, it also comes with more challenges. For example, if you give people too many tokens too quickly, and this inflation may hit you back. I think this is probably going to be a process where people will constantly trial and error and keep innovating. And as users of DeFi, I think they are only going to benefit from all of these experiments. Since we touched upon this point a little bit, we are thinking about how projects are funded, right? Let's say in the Uber case, it's funded mainly by VCs, and now I think things are changing a little bit, at least in the DeFi space. Sometimes the projects are not necessarily funded by VCs. We hear things like community launch, fair launch, or no pre-mine. I think from an investor perspective, how do you guys see this trend? Does it really give you a new way of thinking in terms of investing and helping projects, or it's probably just in line with your thesis, your investment thesis in the past 1 or 2 years? What are your thoughts? How do you look at the new funding model in the space? Michael, you want to give it a try?
Yeah, so just as this is a new design space, investment models are going to change as well. We definitely saw a lot of interest around fair launches, community projects over the last 3 months. At Framework, we're large investors in Wi-Fi. We think that what they're working on is really interesting model, and now we're kind of the first ones to utilize this method of distribution of their token. I think fundamentally, though, when you have a fair launch model, you really do need to put pedal to the metal in terms of how you build an operational model to maintain it. When you have a company that's funded by traditional investors, you have a lot more process and kind of wherewithal to be able to go off and explore and build things and have time. But if you have to put together a community on the fly, a product on the fly, and a user base on the fly, it's a lot more difficult to do that. And if we're talking about things that are ripping, existing software and tweaking parameters or different settings to go after a different variant, the universe of opportunity there is anything that's on chain. And so anything that's novel or new is going to have to go through the traditional funding mechanism. So I'm not super hot on these, sushi swap type variants, but I am very interested in new funding methods where you can build a team and build an operational plan pretty quickly.
Santiago, what's your take on this?
Yeah, I would echo what Michael says. I think we saw this sentiment in 2017, kind of anti-VC, and I always like to remind people that, look, as investors in a lot of these protocols, we commit ourselves in a very meaningful way. I think every single fund in this panel, Framework, Polychain, and us, we really, capital is a commodity in this world, and it has been for a long time. Where you really try to, the competitive deal space in like venture funded deals in crypto is very competitive. And I think, especially in this world of open source, where it doesn't take much capital to bootstrap a network and an idea, and capital moves very quickly, right? And so a founder always has the opportunity to do a fair launch. And I think it brings healthy competition because it keeps us honest and it keeps the community honest. And at the end of the day, for us is, what do we bring to the table? I'll tell you one thing that is probably not appreciated much, which is we are subject to very long vesting schedules. And whenever we do a deal, we are committed for a number of years. And so candidly, I think that is back to your farming construct of fair launches. Some of these fair launches are just disguised as Ponzonomics, right? Where you're giving a token, which is farmable and has no lockup and people can quickly dump it. And so I think I would pose the question, well, what is a better model, right? And I think there is no perfect answer to that. It depends on the type of network. I'd say Ben would probably say, look, if you're investing in a layer one, it requires intellectual firepower, research. It is a much more difficult type of problem to solve than perhaps launching a competitor to Compound and forking Uniswap. So I think there are different types of models that can be funded in different ways. I'm not dismissive of fair launches. I can understand the criticism around some venture funded deals that have pretty terrible vesting schedules and pre-mines. And so I do appreciate that for sure. But it really, I think at the end of the day, it is a little bit too early to call this, anything in this space, really. I'm not prepared to say one thing is better than the other. I simply, for us, is we like to back very technical teams that have, one of the best questions that we ask them is, what have you been doing over the last 2 years, where it was a terrible, brutal bear market? And I think that's always a good indication of true conviction for investors, for founders, for builders, for anyone really in the space.
Thank you. Ben, anything to add?
Yeah, I'm like sympathetic to folks who want a fair launch. I understand that it's hard to watch this space having evolved out of the original fair launch of Bitcoin and seeing VC funds make many millions of dollars because they have early access to deals that the public doesn't. I think that even as recently as sort of 2016, 2017 during the ICO craze, maybe you can debate whether or not those were like fair launches in the way that we're talking about them, but they certainly opened up the possibility of early stage involvement and sort of distributed the risk of those early stage investments in a much more public way. And so I certainly understand people who, from sort of like an ideological perspective, favor those kinds of launches. At the same time, I do think that it's worth thinking about like the teams that have had real staying power in the space, and the teams that have had kind of like been able to build the best brand and build the best products. And I think, Compound is a fantastic example here, right? Robert Leshner is a seasoned entrepreneur. He knows how to operationalize, he knows how to hire, he knows how to build a business, he knows how to build a brand and a community. But ultimately, like, those things take time and they take resources, right? And so I would also say that, like, the reality is investor capital oftentimes provides the basis on which some of the best tools or products or protocols in the space can be built. So, I'm sympathetic to both arguments. This is another one where I think, like, the reality is, investors aren't going anywhere. I think, I touched on this a little bit earlier, but I think part of what's exciting about the broader Web3 ecosystem, and DeFi in particular, is that it allows for the formation of novel new types of capital structures to occur in decentralized and anonymous or pseudonymous ways, such that pools of capital can be governed and allocated in an entirely new fashion, right? And I expect that we will see more of that over time. I expect that those kinds of pools will start to have more complex incentive structures, and that they will start to make more complex types of investments. So that may be a new avenue for founding teams to seek early stage investments if they don't want to go the traditional VC route. But the other thing I'll add is that I don't think that there's anything wrong with founders or founding teams selling part of the protocol in advance to fund that development and to be able to pay themselves for it, right? Like, these people are working very long hours, they're solving very difficult problems, and I would argue that they are bringing a massive sort of social good to the rest of us, and I think that they should be able to earn a living while they're working on that. So I don't really have any problem funding them in advance.
Yeah, with someone with entrepreneur background, I certainly agree with you. I don't think we want a scenario, let's say a prevalent scenario where everyone makes money out of a good project other than the founding team. I think, the founding team should be well compensated and encouraged to continue innovating. I think we are running out of time a little bit, but just one last question. What do you think about the adoption path going forward for, let's say, DeFi applications to take on off-chain assets, from traditional financial world, trade finance, traditional lending space? What do we see as this goes forward? Santiago?
Yeah, I think Michael alluded to this earlier, that this is sort of the next wave, that I think a lot of infrastructure has been built, that we're ready to build these bridges. I think we are kind of moving from dial-up to broadband internet with something like optimism. We're not there yet, but I think there's a lot of solutions that I think are making and are going to be making a very product feature complete, as Michael said, like, DeFi. And in many ways, I think, combine that with macro. I mean, this is a secular trend, but you pair that with record low interest rates, the rollout of Libra, central bank digital currencies. I mean, all of this really, I think, conditions the consumer to using digital currencies. And, I think we're quite excited. On the consumer side, I think a lot of applications like Argent have abstracted away the complexity and the friction points of interacting with crypto. On the more traditional finance, large pools of capital, I think a lot of TradFi players are really interested in finding ways to interact with DeFi because they can be more capital efficient, they can save basis points. And so I think we're going to continue to see more and more of that. I don't think it will be linear in any stretch of the imagination. I think these things don't happen in linear ways, primarily because you've removed a lot of friction that exists in traditional finance. And so one of the things that I think may hold us back temporarily is the lack of proper insurance, which is really a fertile space. I mean, if you look at the evolution of most industries from back to whaling in New England to, you know, cross Atlantic or circumnavigating the world, expeditions back in the 18th century or 17th or 15th century, you needed to have a robust insurance infrastructure in place to support these things. And I think in crypto, we all know what that means. You know, you don't have FDIC insurance, but you have something analogous to that, like Nexus. But I think we need more of that, and I think as it will move in lockstep with more users. But look, MetaMask just crossed 1 million monthly active users.
That's right.
And I think that's a big milestone. They actually took that snapshot the day before Uniswap sort of issued their kind of retroactive token. So I'm quite excited to see the evolution of the space. I think we're going to move very quickly, and maybe next time this year we'll be quite surprised in terms of number of users and also total value locked in these protocols. I think it will not. I don't like to make predictions, but I think it will be greater than. I think it will be greater than perhaps even or imagine wildest dreams would say it is. It's going to be.
Yeah, let's speak again next time. And by then, I hope that we have already made a lot of headway into this off-chain assets. Michael.
Yeah, once again, echoing everything Santiago said, I think, you know, there's two variables for bridging, in particular, real-world assets, and then the next leg up in terms of total value locked or assets in DeFi. The real-world asset bridge really comes down to trustless price feeds of non-crypto assets. It's something that doesn't really exist yet.
Yes.
Metrics has some of the common commodities, but we don't have any trustless asset feeds, price feeds for equities assets. We don't really have it for commodities yet. You know, there are some really big kind of glaring holes in how we can bridge that crypto native ecosystem for DeFi into actual traditional finance assets being traded in DeFi. So that's from a new asset category characterization standpoint. But then everything else that Santiago said on insurance is what's going to get us from 10+ billion of total value locked in DeFi to 100. And once we have that, it limits the scope. It limits the potential loss of any provider who is going to be willing to put in $100 million of stable coins and put it into Curve and farm that. And you won't ever see a single entity coming in from traditional finance being able to do that. But once you have insurance to protect it, they'll be able to. And once those assets are in, they're probably not going to be going anywhere. So, you know, I do truly think that insurance is what gets us from 10 to 100.
Yep, thank you. Insurance and trustless data feeds are something we've got to work on. Any final comments from Ben? Oh, sorry. Go ahead.
As I said, Michael coincidentally is wearing a plaid shirt that reminds me very much of the founder of Chainlink. To his point around price feeds.
I certainly agree that those are two necessary elements, especially the insurance component. I actually think that there are two really significant challenges here. The first is sort of purely technical and infrastructure, which is to say that, you know, I don't think this is particularly a novel insight, but the reality of DeFi right now is that is in equal parts enabled and hindered by Ethereum's technical limitations. I think there's a long way to go in terms of scalability and interoperability before we can have a genuinely seamless experience of trading the kind of volume of assets that we're talking about. So I think that's one major hurdle. Obviously, there's a lot of really brilliant people working on it, and we will get there. The question is more a matter of time. The second is you know, with respect to bringing real world assets on chain, I think there are challenges with respect to tokenization and settlement that I haven't heard compelling answers for yet, and that more often than not rely on the bridges between the decentralized financial world and the traditional financial world being themselves these kind of centralized, trusted bridges. And that may be a compromise that we are willing to make in the short term, but there are still challenges around, you know, the settlement of the sale of tokenized assets, for example, that I think are very difficult. Similarly, like there are real implications for, like, you know, what does this mean for continuing to enforce sanctions, for example, right? Like if anybody around the world can buy and sell and trade, you know, tokenized versions of Apple or Tesla stock, I think you get into some pretty tricky regulatory spaces there. And I'm not saying that's a big issue for the space at large, but at a certain point, those trades have to settle, right? And so at the settlement end, that's an unanswered question, and I think that actually will present a significant barrier going forward. I think that's one example. I think there's a lot of examples around settlement issues that need to be resolved, but that I've not heard real compelling answers for yet.
Yeah, that's really a good point you just brought up. Yeah, for the interim, yes, we are probably fine with whatever settlement methods we have, but in the long run, this is really something we got to work on as well. Thank you, Ben, Michael, and Santiago for this wonderful conversation today. Thank you, everyone, for watching this panel discussion. Hope to see you again very soon. Bye-bye.
Thanks.
Thank you.
Thanks, guys. Appreciate it.
Take care.